Estimated tax is weird, and most people account for their federal estimated tax in the wrong way. Let's take a quick look at how you probably do it today, and then show you a better way. You might remember Alice from our earlier videos. She's the woman with the impossibly cheap apartment. Most of Alice's federal taxes are withheld from her paycheck, so she usually doesn't have to pay federal estimated taxes. But this year, she had a really good investment in the stock market that she sold for a wonderful profit, a $140,000 long-term capital gain. She's going to owe taxes on this, so she wants to pay estimated taxes so that she doesn't face a big outflow next April. If this is her only capital gain, in 2020, she'd owe 15% on $100,000 of her $140,000 gain, because the first $40K is taxed at 0%. So Alice is going to owe $15,000 in taxes above and beyond her withholdings. Split 4 ways, that's $37.50 per quarter. How should she account for this? The way most of us would do this would probably be to journal an expense on the dates you send in the payments. So $37.50 in estimated taxes paid on April 15th, June 15th, September 15th, and January 15th of next year. But there's a problem with doing it this way. Let's look at this simplified income statement showing only her capital gains and her tax payments. Since the final estimated tax payment is going to take place in the next calendar year, this gives Alice a skewed picture of how much tax she paid for this year. Not only that, but that skew will extend into next year's income statement. If Alice wants to know how much in taxes did I pay in 2021, her only recourse is going to be to look at her tax return. That's certainly one way to do it, but shouldn't your account books be able to answer that question for you? Fortunately, there's another way to do this, and to do it, we borrow a technique from accrual accounting. Alice will create a new liability account, not an expense account, a liability account called Income Taxes Payable. On April 15th, we credit the income taxes payable account with the entire amount that we expect to pay in estimated taxes for the year, and we debit our federal tax expense account for the same amount. That's right, we're counting the tax expense for the entire year at the moment that we figure out what it is. Then, each quarter, when we actually send the payment to the IRS, we debit the liability by the amount paid, reducing it. Since the income taxes payable account is a balance sheet account, at any time our net worth reflects the fact that we already owe these taxes, and we're just paying down the liability. Since balance sheet accounts don't get closed out at the end of the year, we don't have to worry about the fourth quarter tax payment messing up our income statement. It all just falls into place. As always, this isn't professional accounting or tax advice. If your accountant recommends a different strategy, by all means listen to them and not me. But if, like me, you've struggled with how to make that fourth quarter payment without messing up your income statement, this technique might be of use to you. Thanks for watching.